You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is financial consultant and wealth manager Richard Knowles of Knowles & Associates in Vancouver. Welcome to the show, Richard.
Thank you very much, Jim.
You were just taking a look at your little ticker there. The TSX has topped 15,000 again. What is that telling us about the Canadian markets?
Well, in spite of the fact that oil has been selling off and all of our oil companies that comprise so much of the Toronto Stock Exchange, including, mining and minerals, which have been suffering for a long time, it's amazing to see that we've just broken through a barrier, which is very important to the Canadian stock technical index, the TSX, and that's 15,000. The last time, for some of our listeners may not have all this in their memory, but we hit an all-time high back in 2008, just prior to the big recession, when the big sell-off of the banks and the global, the U.S. banking crisis, and sent us all into an economic tailspin globally. We had just tipped above 15,000. I don't even believe we closed above 15,000. We'd only been trading above it. We closed at about 14.8, I think, at that time. That was just prior to the big drop off into the fall of 2008. And then, of course, into 2009, we had just started our recovery. Now, from that recovery point, which, by the way, for most of our listeners, was around 8,000 on the index, so that was a heck of a drop from almost 15 down to just a little over 8,000. That's almost a 50% drop. We've climbed precipitously but slowly back up to where we were in 2008. However, we'd only touched on that area back in somewhere around 2011. So about 2-3 years ago, we actually hit back to that near those highs of 15,000, and then we fell back down to probably around 12,000 on the index within about a month, and then continue within a few months, and then continue back up that climb. We just, as of last month, touched on 15.5, actually just a few days ago, 15.3, I think, 15.5, and then we have just trading back down around 15. So we've hit this, it looks to be a technical level at around 15,000. Now this is very good news, and this is in spite of the fact that oil is doing so poorly, and therefore there's a whole part of our Toronto Stock Exchange index which is reflected in oil and gas companies, which have not rebounded and in fact are dragging this return. Now it does speak well, if you're looking at the index as a whole, of course, we have consumers, we have consumer companies, we have merchandising, other types of companies in this index. There seem to be technologies that are financial services. They seem to be taking over from the areas that oil is now weak in. But it's so strong, this consumer rally is so strong, that it's able to surpass the losses on our oil and gas side. Now that's a major issue to note, because the positive nature of the consumer bent right now, in other words, the consumer's perspective of the markets, is extremely good, and the consumer perspective, of our economy looks very, very good. And one of the reasons for that is the fact that the anticipation of lower gas and transportation costs, other types of costs associated with gas and oil, are expected to remain low. That companies that are in the consumer space and other areas that are going to profit quite well, handily, by the way, by lower gas and oil prices, are starting to really be recognized by consumers as being a hot topic, a place to invest. So people are investing more and more into the companies that are going to be indeed profiting from low oil and gas prices, which, if you look at most of the world, is anything that's consumer-based, anything that has to do with merchandising, transportation, any of these stocks will be, or companies that have stocks, will be profiting extremely well. And that's the nature of our market today. While we're hearing lots of doom and gloom about oil and gas, we keep forgetting that we're happy every moment we go out to pump our gas in our cars. We're happy anytime you're buying oil today. If you're living in certain areas where you're still using oil for heat, it's the happiest moment of your life to pay that lower bill, because the pricing cost for direct oil heat is now competitive with natural gas, which it hasn't been for decades. So this is really quite interesting news, and it's very good news, I think, overall for the Canadian economy. We're finally getting back on our feet. It's taken us 7 years, from 2008 to 2015, to get back on our feet.
Has the lower loonie helped?
Yes, of course, because with a lower dollar, you have better exports. So the Americans, who are our biggest client, have been importing more and more of our goods recently. That's been a big boost to our consumer base and our exporters. Lumber companies, for example, that were struggling for exporting, doing terribly with high Canadian dollar, are now profiting immensely with exports to the U.S. because they're able to now pick up that part of the TSX, for example, where oil has dropped, oil stocks have dropped, timber stocks have come up. So, Abitibi and others. So we're in a situation where we have a shifting of this economy of ours. It's shifting away from, if you will, the heroin of oil, and it's now getting to be what I believe to be a healthier economy, a more diverse economy, diversified economy, where we're profiting in our economy from different sectors. Therefore, we're not addicted or requiring one sector to carry the whole weight. Now, that's a terrible thing to say for people in Alberta or Calgary or somewhere, oil towns, where they are struggling and there will be layoffs. But it's not as though oil is going away at this new price point. It just means that profits in those companies and massive expansion, an unfettered expansion, and new oil wells won't be popping out as they were. It will slow their economy down to a normal snail's pace and sort of catch up with the rest of really Canada. Canada's been going at a snail's pace, other than Alberta, for example, which has just been booming, it seems, everywhere. Well, they've been booming too fast, too hard, and in fact, they had to be reined in naturally. It's a natural economic evolution, or revolution, I guess, or it is an evolution, and it's evolved into this natural state, which is, sorry, we can't run our country at these high rates. The rates have come down. Thankfully, I have to thank the Saudis. I hate to say it, but I'm thanking them. I'm not a popular guy, but I'm honest. I'm thanking them for bringing these prices down, because everyone in our economy, apart from those in the oil and gas sector, which may struggle because of layoffs, are profiting from this. Even the people that are laid off today are realizing if they had to be laid off, they would rather be laid off in an economy where oil and gas prices are much lower, where they could at least afford it with whatever income they can make. And also everything else is more affordable in theory, because if they pass on those savings, or the company passes on the savings to the consumer can then purchase more and more of these things at a lower cost.
Well, one company that is not passing on the savings is WestJet. Even though their fuel costs have gone down 30%, they say because they have about an 80% occupancy rate for their airliners, they have no plans to pass on the savings of lower oil prices to you, the consumer.
Yes, and I've heard that news, and it is a little bit disheartening on the one hand, because you would hope that the companies will come to bear for the economy, but ultimately it will be a consumer-driven capital market. So if they do not pass on their savings and people refuse to buy their tickets, they will be forced to reduce their ticket prices. It's a natural competitive nature. WestJet is up against a lot of American, companies, Alaska, lots of, United Airlines, who may indeed pass on their savings, and therefore people will selectively choose against WestJet, because if their prices do not come down and they don't see the savings there, and they can go elsewhere for as equal type of flight over the same flight area, they will. That's natural capital markets are coming into play. WestJet said they are currently not passing it on, but I believe they would pass it on if the competitive nature of the market forced them to. So it's not, it's not a dead duck. It's still quite alive, and the way that they're going to react will be based on capital markets. I believe this Air Canada may have said the same thing, and I'm not sure if it's just WestJet, but it may be a bit of a price concept of Canada. But keep in mind, one thing that I often tell my clients and tell anyone that's listening is that if you have an opportunity to hedge your life in any way, shape, and form, do it. For example, if you're in transportation and you own a transportation company, or you're just a trucker, for example, you're using oil or diesel all the time. One way to hedge against an increasing diesel price for your truck or your business is to actually go out with business money or your personal money and purchase the very stocks which are going up because of these increasing prices. For example, if you're always a trucker going to Exxon and Shell, to hedge against the loss out of your pocket for the higher gas costs, you can actually buy stock of Exxon and Shell, which will be indeed profiting from these higher prices, and you're making the money back by investing in the very companies that are taking your money out of your pocket. The same thing happens if you're in lumber and you know that the lumber prices are going up and you're a construction worker. Well, why not go out and buy shares of the very companies that are in timber that are profiting and going up in value because of these increasing prices, if indeed they are. And so this is a way to hedge your life, if you will, against losses in other areas of our lives. One thing I might say to people that travel all the time, why not hedge these increasing costs? If indeed they are increasing or they aren't decreasing, I can say one thing. These companies, if they don't pass on their savings, their profits are going to be going up. It's almost by definition. They'll either have a higher dividend or they'll be reinvesting in growth. And if they're positioned well over the long term, what does that tell you about either owning their stock or perhaps looking at owning their stock at some point? Now, I don't recommend people take my advice and just run out and do this. You absolutely need an advisor to speak to. If you're not contacting an advisor, getting information on research and just taking this advice, it's not really appropriate. But do definitely look into these opportunities, because this is a way to hedge your life. If you're a frequent flyer and you feel, oh boy, I'm not making any headway, even though gas prices are going down, these stocks are going up, just go ahead and perhaps and hedge your life by owning those very companies.
We'll have more with Richard Knowles right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on The Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking to Richard Knowles of Knowles & Associates. Richard, with interest rates so low in Canada, where can a person go if they want to make a conservative but solid investment that returns more than 1%?
Well, that's a difficult one. As we all know, RSP season is on us. And, if you want to get your RSPs done prior to, for last year, you have until March 1st of this year to be able to make any last-minute deposits, top up any plans. So I recommend people look into that. However, conservative money, it has been struggling in Canada, certainly in North America, simply because we just don't have interest rates to be able to support them. If you look at bond rates, they're struggling at, trying to issue bonds at 2-3%, 4%. And these are long-term bonds, and you can't get them at those rates because the competitive rate today is closer to 1 to 2% at the banks. So GICs are certainly not, don't seem to be a big money maker. So conservative money has been struggling into trying to sell out its guaranteed nature. In other words, those investors that are really seeking guarantees for their principal and trying to get the best rate of return have had to sell out some of their own personal, so to speak, principles by investing in income funds or investments that might be less guaranteed. And they may offer more income, but they're the less sleep at night feeling. Some of the things that have come forward, though, as investments have been quite interesting. In one case, of course, there's been a very popular drive for segregated funds. Segregated funds are, in effect, insured mutual funds. For those of you that know about mutual funds, these are just mutual funds that have been insured by insurance companies, in effect, and they offer guarantees after a period of time. So you can have a 100% principal guarantee after 10 years in many of these companies that you can buy, and it can be invested in stocks and bonds and other things that go up and down in value. But at least in 10 years, it's like a 10-year bond, that you're going to get your principal back. Or better, of course. I mean, if the markets have actually provided you with a better average, you of course get the higher number. But this offers at least the sleep at night feeling to people. You can have your guarantee. You can have your cake and eat it too. You can have your guarantee and still partake in stock markets, for example, or other types of investments that aren't inherently guaranteed, but you know your principal is fixed after a period of time. There's also a lot of estate protection issues. If you happen to pass away during the holding period, 100% of your principal, or better, would be paid to your beneficiaries. So this is a very powerful tool and has been a net recipient of billions and billions of dollars during this time where interest rates have virtually disappeared for guaranteed market investors seeking guarantees. Other alternatives, however, have been coming up, and one thing that hasn't been talked about is the emerging markets term deposit. It's ironic, I suppose, that if you were to go to some of the biggest countries and economies in the world today, North America is one of the biggest, but there's India and China. Currently, you can go to India today, and ignoring the currency differential, you can actually get term deposits upwards of 6%, because their current yields, their interest rates that you can acquire there are very high because their inflation is so high. So you can get, this is similar to what we had, back in the heydays, where you could get a GIC for 6%, for example, for a 5-year or 10-year GIC. Of course, if we had that here today in our economy, the markets would probably correct terribly, because there'd be such a sell-off of the markets of conservative investors there that have been struggling with not having guarantees would sell that out willing to buy at 6% in a guaranteed term deposits. However, it's hard to access these kinds of investments, bonds, and other things that are being offered in these economies. There are certain types of mutual funds that are very valuable at this time for any RSP investor to look at. Excel, for example, and others have come up with some great emerging market bond funds, which have very high yields. Now, these are safe bonds, generally considered safe bonds. They're diversified over many countries, for example, not in Canada, for example. They're in other currencies, so we're even profiting by a dropping dollar by being invested in other currencies other than our own. When our dollar drops, as I was mentioning before our break, this is a way to hedge against a dropping dollar for Canadians. So you invest globally. If you anticipate the dollar to continue to drop, you should be investing in global investments, which are literally in other currencies. Now, of course, if your Canadian dollar goes back up, you could lose your gains that way. But we don't see that happening anytime soon. So this is a window of opportunity for some people to try and gain as much income as they can, to look at global bonds, for example. This kind of strategizing, if you like, or strategy, when you're looking at your portfolio and your RSPs this year, this is a very key component, rather than just throwing money after money and just trying to buy what you had. Rebalancing and looking at the most strategic areas of your portfolio for the next year or two, and then getting back to your advisor once a year to rebalance these portfolios to see where the net benefactor of the next cycle will be, is the key component to a good teamwork between an advisor and a client. And this kind of teamwork is what really is the greatest strategy going forward for success. You have to think more in these markets. Anyone can make money in a bull market where it's going straight up and you have 5 or 7 years of nothing but bull market returns, and there's no negatives on the forefront, and there's high interest rates, and it's a big inflationary environment. But I think we can all agree that over the next many years, we're not going to be getting these straight line market growth curves, that you can't just throw a bunch of money at the same investment you've always had and just let it grow and grow. It may, because if it's well managed and already well diversified portfolio, then you're fine. But if you haven't been diversified and you don't have, not taking advantage of all different types of aspects of the global economy, you are really behind the 8 ball, and you're really not going to get ahead. You have to be able to beat inflation. Not the inflation they're telling you, but the real inflation rate. And as we discussed in our shows and other shows that you've had with other speakers and other people, the real interest rate we know is much higher. The real inflation rate is much higher. I should say, the inflation rate that is posted might be 1 to 2%. But in fact, when you factor back in housing and you factor back in oil, the things that they tried to dump back in the 1990s and 2000s to make inflation look better, we're actually over 9%. So try and beat 9% with GIC. Even if it's paying 6%, you're still losing, especially after tax. So we have to think better. We have to think smarter. So to do that, you have to strategize, and that's the key now for your RSPs.
Richard, as we get closer to the RRSP deadline, we'll talk more about this. Thank you very much for being on the show.
Thank you very much. Pleasure being here.
My guest has been Richard Knowles of Knowles & Associates in Vancouver. If you have any questions for Richard, you can send them to Richard K, the letter K, at customplanfinancial.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Check out our popular YouTube channel, Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.